Good morning and welcome to your Wednesday, September 18th market news update. Fed decision looms and traders marginally favor a jumbo 50 bps rate reduction by the central bank. BlackRock announced the launch of the global AI infrastructure investment partnership with Microsoft to match the growing AI demand of the market. S&P 500 futures hit fresh record highs yesterday as optimism for rate cuts lifts riskier assets. Silver retreats from two-month highs as traders turn cautious ahead of the Fed's policy decision. China's benchmark 10-year treasury yield hit fresh all-time low as pessimism takes hold of investors. The Swiss Franc stays firm near 9-year highs against the dollar at a time where S&P decided to unpeg from the euro. Finally, euro traders brace for the bloc's second HICP estimate for clues about the ECB's rate path onwards. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 18th of September of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first and sole topic of the day is going to be about the Federal Reserve, which apparently has reached the end of their road. So later on today, the main event of the day and possibly the week is the Federal Reserve's policy decision for the meeting of September, which will take place in today's American session. And traders are indeed increasingly gearing up for the announcement, but also for the commentary from the FOMC, which possibly could contain any forward-looking data, which is going to be scattered in the accompanying statement. And this is going to be studied closely for clues about what is expected by the Federal Reserve going forward. So economists do foresee that the central bank will officially pivot towards looser financial conditions in this meeting of September and slash their key policy rate after 4 years, reducing the federal funds rate from the 5.25 to 5% level, which is a 23-year high, as inflation has moderated substantially in recent months and upside risks of inflation, for recognition words in a sense, have also been suppressed. Now, speaking of inflation, the latest annual CPI reading recorded its fifth straight monthly decline to the 2.5% level in the month of August, the lowest reading since 2021. And we have seen core PCE, the Fed's favorite inflation gauge, if you like, hovering at the 2.6% level according to quote-unquote latest data we have had, which is for the July July month. So the core CPI rate, which excludes volatile food and energy prices, indeed is standing at 3-year lows, which is a 3.2% level. So overall, we have seen inflationary pressures abiding and moving closer to the bank's 2% target. That's why we get this kind of unanimous kind of consensus that the goal has been met, and now from here onwards, the Federal Reserve will have no other chance but to reduce its policy rate from here onwards in order to, let's just say, allow the American economy to breathe once again and hopefully head to higher ground. Now, currently it appears that there is not much of a debate of as to whether the Federal Reserve will slash rates in today's session. Is actually being seen as inevitable given the data, but rather the conversation is revolving around the magnitude of the rate reduction. Is it going to be 25 or 50 basis points? In a sense, that is the question. So money market participants are aligning or setting themselves up in the camp for a 50 basis point, a larger 50 basis point rate reduction in today's session, and they assign a 63% probability for this scenario. As they have been placing more and more importance, not only on the inflation prints that they're actually making substantial progress, but also on the recent cracks that have been shown to arise from the labor market of the United States. So some sort of deceleration of job growth and also the rise of the unemployment rate to the 4.2% level in the last kind of release, but also not failing, but how are you going to say, slumping, or not that much growing in regards to earnings from employees over the past few sessions now, which those are the worries. That's why the majority, quote unquote, majority of the market, 2/3 of the market are expecting the 50 basis points, whereas headline expectations from polled economists favor a 25 basis point cut, much like synchronizing to the Federal Reserve's kind of rationale, or at least the past decisions they have made, and favoring caution in a sense. So again, at the end of the day, we will see whether we're going to see much more dovish reaction from the Federal Reserve by slashing 50 and starting their loosening campaign or the easing campaign with resolve and strength, or we're going to see them being quasi-cautious and going for a 25 basis point cut into the session. Super, super important decision. We will see how the whole thing is going to materialize. So onwards, going further from here, from the September meeting, markets are foreseeing a follow-up 25 basis point cut in November, and another, if we see a 50 basis point today, so another jumbo 50 basis point cut in December, which is going to leave an implied terminal federal funds rate of 4 to 4.25% by year's end of 2024. And it's needless to say, but there we go, we should point it out. The reality check will be provided by the FOMC's updated dot plot graph, which would somewhat telegraph there being policymakers' intentions going forward as in regards to policy decisions, but also from the updated inflation expectations. So we're going to have current year, 1 year, 3 year, and 5 year projections coming out in today's session, quarterly kind of update. And of crucial importance will also be the FOMC's accompanying statement, which is going to lay out in detail how policymakers are assessing the situation, not only domestically in the United States, but internationally, how that is going to affect their decisions going forward, and how that has already affected their decision in today's session to go for either a 25 or a 50 basis point cut. And these are going to be valuable insights because they outlay the views or the point of views from the FOMC committee, the ones that are actually deciding on policy decisions. And we're also going to see the summary of economic projections. Super, super important. We're going to see GDP predictions going forward. Maybe a parameter that has not been up in the hierarchy of catalysts, if you would like, as to how the Federal Reserve is going to behave going forward. We have seen inflation as it should, but also we have seen the labor market. So the two, if you would like, key core mandates that the Federal Reserve have been discussed in these prior few meetings and monthly releases. So again, maybe GDP is going to come into the picture as well in order to get a much more holistic kind of point of view. Because if indeed we see a severe slowdown of the labor market, GDP prints are definitely going to be impacted. And how harsh, that is to be told depending on incoming information. So last but not least, traders are indeed expected to be glued to their seats at the time where the chair of the Federal Reserve, Jerome Powell, is going to be taking the stand, as interviewers will be asking, and this is, again, hopefully pressing questions for clarifications about the decision, but also expectations going forward from there. We have seen commentary from Fed Chair Powell moving the market, not as much as prior chairs of the Federal Reserve, but still we have seen Chair Powell being moderately, over a prolonged period of time, being some sort of cautious and being some sort of restricted as to what is going to be said. Maybe today is going to deliver a substantially kind of dovish message, who knows? Or maybe we're going to see the same kind of rhetoric or kind of stance or attitude being presented yet again by Fed Chair Powell. Again, to be seen. So this brings us to today's end of the session, guys. Thanks for watching. And hopefully we're going to catch you on to tomorrow's session for another brief update. Probably it's going to be about what has happened with today's decision, super crucial. But tomorrow we're going to have the Bank of England. We're going to have the Central Bank of Turkey. We're going to have Norges Bank. On Friday, we're going to have Bank of Japan and PBOC. So super monetary policy driven kind of week. Hopefully we're going to do short and brief updates on each and every one of those central banks and their expectations going forward. For the time being, let's just keep it here. Thanks for watching and have a lovely, lovely day. Take care. Bye-bye. Okay, so for those of you that haven't, treat this webinar as the first one of your own initiation, if you like, into trading, or at least understanding how the whole thing works. Throughout this series, we're going to provide you with the necessary, at least attempt to provide you with the necessary tools, at least from our point of view. What are the most useful tools that you need to have in your arsenal when you want to go at trading? So we're going to cover a lot of topics. We're going to go over a few on a much more deeper level, if you would like. We're going to cover some on a much more superficial level, mainly because they are extremely simple to understand. If there is any need to go any deeper on all those affirmation topics, we will upon your request. But for the time being, the session or the series is going to be scheduled much like we have in the past. So we're going to introduce a new topic each and every week. And by the end of 3 months, you could be deemed as quote unquote ready to embark on your journey on trading. Okay. Obviously, you're going to have to do a lot of studying on your own. But yeah, the topics that we will introduce today serve as the main pillars, okay, of trading. You have to understand how the whole thing works. First, we're going to introduce concepts of how the market is actually working. We're going to introduce a few ways of how you can, if you like, reduce the noise and find much more easily your way through the markets. Okay, so we're going to introduce topics in regards to both technical analysis and fundamental analysis. Primarily, we're going to be focusing and more skewed towards the technical aspect, because the fundamental aspect requires a lot of study and a lot of time for us to prepare such materials. But fear not, we have topics in regards to fundamentals as well, at least the basic ones, okay, that you can understand how the whole machine is actually operating. But yes, we're going to delve a little more deeper into the technical aspect of things, mainly because it's much more easier to convey that kind of information to those people that have no prior knowledge. And we're going to cover topics from, for example, identifying specific chart patterns, okay, how you can use them in your own benefit. We're going to introduce the basic tools that a trader needs to have in order to be successful at trading. And we're talking about the super basic stuff that once you compile them all together, you're going to give it nice indications and signals of when to enter, when to exit a position. So for example, we're going to introduce the concepts of support and resistance levels. We're going to draw trend lines. We're going to do chart pattern identification. We're going to do study of individual candlesticks. We're going to do a study of compiling maximum 5 candles to create this aforementioned candlestick patterns. We're going to introduce also a wide array of technical indicators that you can plot on your chart in order to aid you identifying what the major trend is, where there's a potential pivot point coming at, how to set and measure your exit positions, percentage, for example, calculating a basic risk-reward ratio beforehand, before you go into a trade. We're going to do a lot of different things. We're going to do delve into the psychological aspect of trading. We're going to do risk management techniques. We're also going to do live trading sessions together to see, after we have accumulated a lovely base of knowledge, how you can actually put that into practice and trade in a real live environment together. So there is plenty of things to cover. For example, something I failed to mention, we're going to do also Elliott wave theory in this series. We're going to do basic Fibonacci retracement tools. We're going to do, again, wide array of different indicators, for example, RSI. We're going to do commodity channel index. We're going to visit momentum. We're going to do moving average, divergence, convergence. We have parabolic saw. We're going to do an introduction into the Ichimoku kind of method of trading. We're going to do a lot of things. So it's going to take us some time to get there, but let's not rush. Okay, let's start from the beginning and let's talk about what we're going to cover in today's session. So today's session is going to be a brief introductory sneak peek kind of course or session, if you would like. Okay, so it's going to be a brief overview of what to expect and how to approach trading. Don't expect much detail in this one. We're going to outline a few basic underlying concepts of the structure. In a sense, setting up the foreground on which we will step upon and build upon as we progress through time. So it's going to be a brief intro to trading. We're going to go over a few basic explanations and terminologies. We're going to present to you various options, okay, of what kind of trader you can become depending upon the time. Obviously, you have to, or depending upon the time you are willing to assign to this kind of activity, which we call trading. And lastly, we're going to finish with what kind of products can you trade with T4Trade. Okay, for the time being, enough of me about blabbering about stuff. Hopefully you have enjoyed this brief intro, this scope, this overview of contents that we will discuss over throughout our series. So let me end on that, and let's start with today's session. So before we go into the details, I have to go over a small and quick risk warning and a risk disclaimer, and we will be briefly and quickly on our way. So please bear with me. So risk warning: our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. Now, these products may not be suitable for everyone, and you should ensure that you understand all the risks involved. Now, the disclaimer is, pardon me, the information in this webinar shall not be considered as investment advice or investment recommendation, but it is for educational purposes only. Now, this material is just a personal opinion of the author, and the client investment objectives and risk tolerance have not been considered. T4Trade is not responsible for any loss arising from any information contained herein, and their redistribution of the material is strictly prohibited. Now, let's begin. Now, what we will go over in this first session, again, brief overview of what you can expect throughout this series. We've done that. Let's dive into today's agenda, if you would like. So we're going to go over a brief introduction to Forex. What is it? Okay. How can you benefit from trading Forex, or at least once you understand what trading is, what Forex is, how you can benefit upon that, what kind of stuff you can do with FX. Okay, we'll talk about this. We're also going to introduce a basic key terminology. We're going to, or the one we branded as trading slang. Then we're going to visit a few questions that are not primarily constructed for giving answers, but more like enticing you to think about at your own time, for example, how much time you need to trade, or what kind of trader you can become, or what are the different types or approaches towards trading. These are open-ended questions. Treat them like what ifs, okay, and answer in a sense by yourself. It's kind of subjective to ask these questions, but the answer is going to be obviously tailor-made for yourself once you answer those questions yourself, okay? So, and lastly, we're going to close with what kind of products you can trade with T4Trade, okay? So, beginning with an intro into Forex. Okay, what is Forex and how does it work? Okay, a term is in a nutshell, for the Forex term in a nutshell is in a sense refers to the exchange of one currency, okay, to another foreign currency. Okay, so it's a exchange between two currencies. Obviously, the one is going to be the one you are actually holding in your own country, depending on where you are in the world. For example, if you're in India, it's going to be the Indian rupee. If you're in the United States, that's going to be the United States dollar. If you're in Europe, depending upon where you are, for example, if you're in Norway, you're going to have the Norwegian krona. If you're in Spain, you're going to have euro. If you're in Switzerland, you're going to have a Swiss franc. So there is a wide array of different currencies out there. We can begin saying that each and every country has its own respective currency, but that is not true. We have a few exceptions. For example, one obvious one is going to be the countries in Europe, okay? So we have a coalition of nations that fall under the bracket of what we call European Union or Eurozone. So we have, as I just said, a coalition or a team of nations that came together and they adopted the euro as their own base currency, if you like, the currency that they will be exchanging value between them. Okay, some European nations that are in the continent of Europe are not actually have not adopted the euro, and they hold on to their own countries' currencies, the one that been having since whatever X amount period of time they have. For example, as I just mentioned, if you go to France, Italy, Spain, Greece, many other countries as well, they have which are primarily based in Eurozone, you have the euro as their exchange kind of value. The fiat currency is the euro that they use to exchange value, whereas countries that are in Europe, in the continent of the European continent in general, they do not have the euro. They have not adopted the euro, and the ones that we just mentioned, for example, the Norwegian krona, the Swedish krona, the Polish zloty is another one, Swiss franc is another one. You have a different many countries that hold on to their own country's currency, whereas you have others that brand it together. But as a general rule, you have countries have their own respective currency that they are actually exchanging with other nations for their own respective purposes. For example, basic one is going to be trade. Okay, so in a sense, Forex is an acronym, and you can clearly see that from the second line here, which is Forex, in a sense, means foreign exchange. Okay, so changing your own currency, own country's currency, the one that you actually go by day to day and buy stuff to survive. Okay, and you exchange that kind of currency for whatever reason, either you're traveling or you're doing business with some other foreign country. You exchange your base currency with the other country's currency, and that is the reason why we have the Forex market. Facilitates this exchange, or at least gives you the interrelationships between countries' currencies, because they are intimately tied with trading. So therefore, if I need to buy something that is manufactured in, for example, the UK, the United Kingdom, I will have to pay that manufacturer, okay, in its local currency, which is the British pound. I'm currently, for example, holding euro. Okay, so I need to know the exchange rate of euro with the British pound, euro GBP, in order to do and facilitate my transaction. Okay, so in a sense, if I want to buy something, I'm going to sell, for example, if I'm holding euro, I'm going to sell the euro in order to buy the British pound in order to facilitate that transaction. And he has the guy that is actually providing me with the manufactured goods from the UK, he or she has to sell the British pound and buy euro, in a sense, to facilitate that kind of trade. Okay, so that is, in a sense, in a nutshell, what foreign exchange is. So exchange rates, or FX rates, state the price of exchanging one currency into another currency at any given moment. So you need to understand here that there is an aspect of time, a component of time that we need to address. Okay, so for each and every moment in time, you have a different exchange rate between two countries, or two currencies, much more accurately. Okay, so that fluctuation between the price, okay, the quoted price of that specific pair, changes depending upon the economic, socio-political, and geopolitical kind of events, okay, that influence these kind of exchange rates. Okay, so the time dimension needs to be addressed. For example, if I want to exchange something currently, and I'm holding euro with someone in the US, I need to obviously take note of the euro USD FX rate. Okay, so I need to buy something now, and the price of buying something now, okay, is going to change the exchange rate is going to change from time to time. Okay, so there is a time dimension that I need to take into consideration. Okay, and in this, we're talking about from a broader perspective. In the FX market, this is what you, in a sense, are attempting to profit upon. These fluctuations at any given direction between the interrelationships of two currencies, which we call FX rates. Okay, so for example, if the UK economy is performing much better than the European continent's economy, Eurozone's economy, you will reasonably expect to see the pound strengthening in regards to the euro. Okay, so much stronger pound against the euro. And you see this kind of interrelationship, this snapshot being taken care of each and every second, minute, hour, day, week, month, year, etc. So you're gonna have a fluctuating price depending on the specific events that are actually taking place at that point in time. Okay, that is in a sense what affects the FX rates of countries, and this is what in trading we are attempting to capitalize upon if we need, and only if we make a correct assessment to see you know what, we expect to see the European continent bouncing and outperforming the UK economy. Therefore, we expect the euro to outperform the pound. Therefore, we go long or we buy euro and sell pound in order to capitalize on this difference. Okay, so fear not, we're gonna delve a little bit more deeper as we progress throughout the series. For the time being, these are the basic stuff that you need to have in the back of your mind in order to understand how and why we have an FX market. Okay, so fun facts about the FX market: foreign exchange market is open 24 hours a day and 5 days a week, and the Forex market is the most liquid market out there with around $6.6 trillion of turnover each and every day. So therefore, there's plenty of opportunities to capitalize upon, okay, when it comes to trading, speculating whether the FX rate of two currencies is going to go up or down depending on the economic outlook. Okay, so let's look at an example for better understanding. So let's say, for example, that you live in the United States and you want to travel to Japan for holidays. Therefore, you are a holder of United States dollar, what we call the greenback dollar. Okay, if you want to go and do your day-to-day stuff in the United States, obviously you need to hold dollars. You cannot go into a shop in the United States with euro in your pocket and you say, you know what, I'm going to buy these, I don't know, Coca-Cola or whatever that is, with euro. You're not going to get any of that. You have to exchange that euro into dollars in order to facilitate, in a sense, transactions in that specific market. So therefore, based on our example here, we currently hold United States dollar and we want to go into Japan for holidays. So before holiday, let's assume that is today. This is the FX rate. So dollar against the Japanese yen. 1 United States dollar gives you 100 yen. Okay, so this is the FX rate. FX of US, pardon me with my scribbles here, USD JPY currently is at 100. That means I can switch or I can exchange $1 that I currently hold into a yen now, and I will get 100 yen back. Okay, this is a hypothetical scenario. The actual FX rate between dollar and yen is currently somewhere around the 140 something, 45, 6, 7, 8 range, somewhere in there. Okay, so this is for purposes of simplistic understanding of what we're talking about with FX rates here. Okay, so dollar yen pair is currently at 100. So let's just say we went to Japan. Basically, before we go into Japan, we say we wanted to switch and use $1,000 in order to get the respective yen for our time that we will spend there and facilitate transactions. Okay, so we use $1,000, okay, at the current rate, which is $100 per 100 yen per dollar. So we have 1,000 yen in our pockets right now, and we board into the plane and we go to Japan. Okay, So we are currently have flown into Japan and assume this is day 2. Okay. So day 2, we have $100,000, 100,000 yen in our pockets. We go and do our stuff. We buy, go out and dine, have fine sushi and sashimi, and we drink sake and all that kind of stuff. Okay. We have fun. We do karaoke and all that kind of lovely stuff. Okay. And the journey or the holidays are done. Okay. So we have to fly back to the United States dollar. We have to fly back to the United States, and we have these kind of yen left out back in our pockets. Okay. So at the end of the day, moving back to United States, after our brief holiday to Japan, we see that the exchange rate, okay, changed, obviously, from $1 now you can get 110 yen. Okay, how does that impact, okay, our holdings? Okay, so the question here is, did you make money or did you lose money after your trip? Okay, so for the sake of the example, let's assume that you just didn't spend anything. Okay, I know it's unrealistic, I know, but still, have this in the back of your mind. Let's just say that you went to Japan, you didn't spend anything, or someone else bought your food and was covered by everything, by your companions, and you didn't have to spend any money. Okay, assume that is the scenario over here. Okay, so you bought the plane to go back into the United States, and you have 100,000 yen left in your pocket. So you spent nothing. Okay. Hopefully I would love to have this kind of trip, but I wouldn't have to pay anything and someone else does it for me and I take the money back just like it is intact. Assume this is the scenario. So before the trip, okay, we said that we exchanged $1,000 to 100,000 yen. We have 100,000 yen in our pockets and we head back to the United States. We need to change that yen into the United States dollar back in order to facilitate our day-to-day transactions in the States. Okay, so how does this impact our holdings? Okay, so basically what happened here is that the dollar strengthened while the yen weakened, and we're talking about, if you remember from our prior example, before holiday we exchanged $1 and we got 100 yen. We exchanged 1,000 and we got 100,000. After the holiday, the exchange rate changed from 100 yen, okay, to 110. So in a sense, okay, the yen weakened, okay, much more accurately, the United States dollar strengthened, and therefore you can get more yen with the same amount of dollars. So $1 now is, after our trip, is worth 110 yen. So at the end of the day, we would have lost money, okay, on our brief journey, mainly because now we are holding yen. Okay, we are currently holding yen. So we're currently holding 100,000 yen, but the exchange rate for $1 towards yen is at 110. So we bought it at 100. We exchanged it at 100. Now the rate, it has moved higher. Okay, the dollar strengthened, the yen weakened. Now we have 110 as the exchange rate. So therefore, we have lost money because we have to convert the 100,000 yen back to United States dollar using the FX rate of the dollar yen. And we left with $909. So we lost value of $91 in a sense because the yen weakened and the dollar strengthened within this brief period. So you realize the whole concept of foreign exchange is time sensitive. Okay, so this is what we are actually attempting to arbitrage, if you would like, when we're trading, or at least what we're trying to capitalize upon is these fluctuations in values between FX rates between two currencies. Okay, so hopefully this is understandable from your side. It's a super simple example, and we will If not, we will cover a few more examples in the near future to understand, okay, how the whole thing turns out. Now, what happened and in a sense pushed the FX rate from 100 to 110 yen per dollar? That's a question for a different time. As I mentioned in the intro, you have a wide array of different components or different underlying factors that are contributing towards the fluctuation of these exchange rates, mainly due upon economic news releases and the gauge between what's going on between the two economies. You also have monetary policy practices. You have growth and employment statistics coming out frequently. These what we call financial and economic data coming out, which fluctuates depending upon the wider economic environment. These geopolitical events also are something else that affects the performance of FX rates or the relationship between two countries' currencies. There are a wide array of different parameters that are actually influencing, and these are what we're going to be studying much more closely in order to gain a competitive advantage and stay on top of our trading strategy or journey or plans or whatever you want to call it. Okay, so enough about how you calculate FX, what is FX, how do you use them, why you use them, how FX rates are calculated. Let's move on to the next topic, which is going to be key terminologies, key trading slang that you may or may not hear if you are starting your journey in regards to trading. You're going to have a lot of people throwing out terminologies and lingo that you don't understand. Here, we're going to view a few that you may need to familiarize yourself with. Okay. So let's begin with long and short. In a sense, long and short are different ways of saying buying, or selling something. So long and short are primarily indications of the direction that you or whoever else around you or trader around you is throwing at you. Okay, so you might encounter someone saying, "Oh, I went long Euro USD at 107." Okay, so what does that even mean? Okay, going long means buying, okay, in a sense, the contract of Euro USD, okay, a pair, the FX rate of Euro USD. So in a sense, when you're buying something, you are hoping, okay, at least you are assessing that in the near future or whatever the amount of time you are actually holding behind your head, okay, that you are betting that the Euro against the United States dollar is going to strengthen, and therefore you're going to have a stronger FX rate. For example, if you go long Euro USD at 107, 1.07, okay, for the sake of simplistic scenario providing here, okay, in a sense, when you go long, you buy this kind of contract expecting that it's going to rise higher than the price that you have bought it. So 107, you expect to make money by going long, assessing or assuming that the price action is going to move to 108, 110, or whatever that is in order to close the position and make money. Okay, going short, in a sense, you, for example, think that the price or the price of Apple, okay, is currently overvalued, and you think for whatever reason that Apple is not gonna perform as well in the near future. Therefore, you expect its share price to fall, given this very simplistic, crude, and bland way of looking at things, that they're gonna underperform in the next, I don't know, month, 2, 3, 4 months. Okay. Therefore, you are going short, okay, meaning that you are selling, okay, Apple stock with a sense that you need to capitalize upon the fall of the price action, meaning that you will gain money by taking the opposite direction that the stock is actually holding at. Okay, so going short, in a sense, requires you borrowing some money from the broker in order to go short. let's not go into much more detail than that. So bear in mind at the end of the day that long means buying something, short means selling something. Okay, this is pretty much it. That's all you need to know for the time being. Now, bullish and bearish in regards, this is thrown out in regards to primarily momentum and sentiment gauges throughout the market. So when you say, you're going to hear someone saying that there is bullish or bullishness or bullish sentiment surrounding, for example, gold, that means they are saying, I am expecting that the price of gold is going to move to higher ground. This is in a sense what bullish and bear and bullish in this kind of case means when someone says, I'm bullish on gold, I'm bullish on crypto, I'm bullish on Euro USD. Okay, that means they are believing the price action is going to move to higher ground. Okay, also bullish or bearish can be used to categorize or identify the direction of a specific instrument or specific asset. For example, when you say crude oil or WTI is currently bearish, is in a bearish kind of trend, gives you an indication that in a sense, they are describing the trajectory of the price action of WTI. Okay, that is how you use bullish and bearish. Bullish means you indicate, or at least you're broadcasting or you're highlighting that something tends to move to higher ground or appreciate in value, whereas bearish means something is moving south, okay, moving downwards. That means is actually depreciating in value. That's in a sense what bullish and bearish is. And you can spot the relationship between the former, okay, the prior to key slang which I just mentioned, long and short, bullish and bearish. So when someone says, I'm bullish on gold, I'm going long, that means they expect the price action of gold to move to higher ground. Therefore, they're placing a buy order. Okay. So when someone says, for example, I see crude, I'm bearish on crude oil, therefore I'm going short, means in a sense that they expect or they see that the price of crude is going to ease, it's going to move to lower ground, it's going to decrease, okay? Therefore, they are selling crude in order to capitalize on the fall, okay? Pretty self-explanatory, pretty simple terms to acknowledge and keep an eye out, okay? So now moving on to majors, minors, and exotic currency pairs. So majors, minors, and exotic pairs, this is the hint. He's talking about FX, okay? So exchange rates, the topic we have discussed in the prior 2-3 slides. So the interrelationship between two currencies or two countries' currencies, okay? So majors are a bundle of the 7 most widely known currencies or most traded currencies from major developed economies, which we call the G7. And they are, in a sense, constructed using the United States dollar on one or the other side. So we have the base and the quote currency. Okay, let me explain what I mean by this. So the FX majors, okay, have the United States dollar on either side of the equation. Okay, so that means, for example, the prior example we just had, the USD JPY dollar against the Japanese yen. Okay, this is a major pair because the United States dollar is considered by the international community as the or would you reasonably brand this as the world's leading method or fiat currency of exchanging value, okay, or at least the currency that most settlements are taking place around. So United States dollar, okay, is a major currency, is the world's leading safe haven asset currency, if you would like, okay. And you have, in contrast, okay, the relationship between the other major economies, which are Japan's, we're talking about the yen, you have the euro, and this is going to be the other side of the equation. You're going to see what I mean right now. Okay. So when I said earlier on, you can find the dollar, okay, on major pairs on either side. So this is what we call the one side and what the other. So base and quote, okay, base currency and the quote currency. In this kind of case, you have the United States dollar, okay, on the core currency, whereas you have the euro on the base. Okay, never mind about this. At the end of the day, this is the relationship between two currencies. In this kind of case, you have the dollar against the United States, against the Japanese yen. And in this case, you have the euro against the United States dollar. So it's a relationship between two different currencies. Okay, so other currencies that you will find under the bracket of majors is going to be for example, the Australian dollar, so AUD. You're going to have the Canadian dollar, or the loonie, what we call loonie. Okay. So you have, again, Japanese yen. Also, you have the euro, and you have also which did we leave out? GBP, the British pound. And you also have CHF, which is the Swiss franc. So you have 1, 2, 3, 4, 5, 6. Some people like to use the New Zealand dollar as well in their majors. Point of discussion, point of debate. At the end of the day, who cares? Okay, so majors, you can consider these. And remember, all these, okay, are going against the United States dollar. The United States dollar is on either the base or the quote side of this equation. Okay, those are what we call the major pair currencies. Okay, so the minors are, in a sense, interrelationships without the US dollar in them. Okay, so in a sense, you can have the Aussie against the Japanese yen, or the euro against the GBP. Oh my days, this is horrible. Yep, this is B, this is P. Okay, so Great Britain's pound. So we're talking about the currency for the United Kingdom. Okay, so you're gonna have Euro GBP as another minor. Also remember that minors are called crosses. Yep. Okay, mainly because you have this kind of intermingling or the crossing between all the other major economies, kind of currencies, without, okay, the United States dollar on either side. Okay, so crosses are, for example, in this kind of case, you are going to have GBP against the Swiss franc, or the euro against the New Zealand dollar, or the Canadian dollar against the euro. It's going to be euro CAD, etc. So something that these are relationships that do not include the United States dollar in the pair, but they are of major economies. And you're going to have the last category, which are what we call exotics. Okay, so exotic currency pairs are pairs that are formed mainly with the United States dollar, but they do not have all these included in here. Okay, can you see my mouse? Hopefully you can see my mouse. FX, exotic currency pairs most of the time have the dollar or one side. Okay, either base, either quote. This is the base. Let me just make it as clear as I can. And quote. Okay, we're talking about on which side. My handwriting is horrible. Okay, so they have the United States dollar on one side, either the base or the quote side of the pair, but they are including none of these we just mentioned here. So the question is, what are they having? For example, an exotic pair can be the dollar, okay, USD against the Turkish lira, so TRY, or the dollar against the Norwegian krona, so you're gonna have NOK, or you're gonna have the dollar against the Indian rupee, so INR, or you can have, for example, the dollar against the Singaporean dollar, so DG, SGD, Singaporean dollar, or you're gonna have, for example, the South African rand, which is the ZAR. Okay, so exotic pairs are currency pairs between two are pairs between two currencies. One is going to be the United States dollar, and the other is going to be one of minor or emerging kind of market. For example, South Africa, you can have Saudi Arabia, you can have Indonesia, you can have Argentina, you can have I don't know, Chinese yuan for some reason is called an exotic currency pair, no in my books, but still. But yeah, this is in a sense the basic categorization of majors, minors, and exotic currency pairs. Okay, so these are the rules that you need to remember. If you don't have good recollection of what I just mentioned, you can go briefly onto your MT4 platform or whatever platform you can use. Okay, so you go on to your market watch. Okay, if you control and press the control button and M, you're going to get the market watch and you can see all those kind of pairs there. You can right click on that lovely list. You can go to the symbols selection, press on symbols, and you're going to see this categorization of majors, minors, exotic currency pairs, which are falling under which kind of category for you to have just brief, I don't know, let's just say idea of how these pairs are categorized. Okay, so moving on to the next bout of lingo, hawkish and dovish. Mainly when we talk about, when you hear these kind of terms, hawkish and dovish, mainly they refer about central banks policy actions. For example, if a specific economy, if you have been paying attention on what's going on over the past year and a half, so you have a major flux of many central banks hiking rates. That means hiking interest rates. That means rising the benchmark rates that they have in their own respective economies. So when you see an economy, a central bank hiking rates, that means raising interest rates, that action is branded as hawkish. Okay, so by tightening the supply of money, which is what happens once you raise the interest rates. Okay, so you can brand this kind of decision by the central bank as hawkish. Whereas where we currently stand in this point in time in regards to the wider economic environment, you have many central banks, most prominently, let's speak about the Federal Reserve and from the United States, the Central Bank of the United States. They are currently contemplating on cutting rates after they have risen them to 5.5%. So when you have central banks pondering or start cutting rates, that means reducing the rate of interest rates, okay? The level of interest rates, okay? You tend to brand this kind of action, the reduction of interest rates, as dovish, okay? So that's good for the economy. You're going to see stock market rising and all that kind of lovely stuff. We're not going to discuss them right now because I can't speak about this for 2 hours. Let's not go into this. Let's stick to the simple stuff, okay? So hawkish means, in a sense, are attempts to describe aggressive tightening actions by central banks, whereas dovish is much more looser. If you, for example, look at the Bank of Japan, you can definitely brand their approach when in regards to interest rates or their monetary policy decisions as certainly dovish. They are the only central bank in the world, if I'm not mistaken, maybe there may be another couple of them, that they did not raise interest rates over the past year or so. They keep their interest rates in the negatives at 0.1%. That means they're definitely a dovish central bank, or the policy actions are certainly dovish in comparison to other central banks that they have been raising interest rates. For example, ECB, the European Central Bank, or the Bank of England, etc., etc., etc. Okay, so this is in a sense what we say about hawkish and dovish. Okay, so next lingo is pips, which are in a sense abbreviation of percentage in percentage. You're going to see what I mean by this right now. So it refers to the exchanges in the fourth decimal place of any major currency or any given currency pair anyway, with the exception of the yen, which is quoted at the second decimal. So the yen is, you can find the current price of yen somewhere around this kind of range. I can't really remember exactly. You will not have any other decimal places in comparison, for example, with, let me do this USD, please bear with me, JPY, in comparison with, for example, Euro USD, which if you pull up the bid and ask the price currently that you can buy or sell this kind of pair, you're going to see that is denominated in 4 decimal places. Okay, 1, 2, 3, 4. Okay, sometimes you may add the pipette, which is the 5th. Okay, so for the time being, we're talking about pips. So when we say about pips, we're talking about this one right here. Okay, so any change, okay, in the 4th, 1, 2, 3, 4, 4th decimal place of any major currency pair, exception the Japanese yen. Okay, so pip stands for percentage in percentage. Okay, that's why I said this. Okay, so it's a percent. Pips, in a sense, measure the percentage change of the percentage change of any given price action. So, for example, when you see traders say, okay, that price of whatever instrument, whatever FX pair you're actually looking at, increased by 1 pip, okay, they mean it went up by this much. Okay, so when I say Euro USD moved north, okay, gained 1 pip, okay, that means that is in a sense that the price, the FX rate of Euro USD, okay, currently right now, and in a second. So now you can see the price action moving by 1 pip higher. Now the price action of now the actual rate of exchange between the euro and the United States dollar is at this. It moved by 1 pip. So you add 1 unit to the 4th, 1, 2, 3, 4 decimal place of that specific FX pair, which is in our case Euro USD. Okay, if we say it went up by 10 pips, that means the price action, the current price is this. Okay, so 2, 3, 4. Okay, so 10. Okay, 10 pips is what we call 1 point. Okay, so remember, 10 pips equals 1 point. Okay, that's pretty much it. Something else to remember. If I say, for example, at the time of a specific release, for example, okay, NFP comes out and it's bad, okay, and you see the dollar index, okay, or the Euro USD, okay, and you see there's bad news coming out for the United States economy, you expect the Euro USD as a pair to move to higher ground, mainly because the dollar is going to weaken. Therefore, if I say at the time of the release, NFP has lost 300 pips, what does it mean? And you assume that the price action is right here at the time of the release. And after the release, it has moved north by 300 pips. That means this has changed to what? Okay, so this is 1 pip. Okay, that is 10 points. Okay, so this, you add 300 to this. So the new price is this. Okay, pretty self-explanatory. Okay, enough about pips. Super simple to understand. Moving on to the next slide, to our next key lingo. It's going to be about safe haven. Okay, safe haven, in a sense, is a term that we describe assets or instruments in the financial markets that are proven to hold on to their value in times of despair or in times of geopolitical risk or in times of recession. Okay, there are certain safe haven assets that traders or investors move their money towards in order to safeguard from unfavorable market conditions. Okay, this is pretty much what it means, safe haven. Okay, says it in the word. For example, if we have I don't know, war starting out as we have in Middle East currently with Israel and Hamas, okay, and possibly we can see this kind of flare up of tensions between Lebanon as well, and you have the Houthis in no, Oman. What is it? Yemen. Okay. The Houthis in Yemen, and you have Iran as well, having trouble with their own bombings during about 2 days ago. You can see the flare up tensions for a wider conflict in the Middle East. That is certainly an area where investors are going to be paying close attention to, which means if they fear that there's going to be some sort of aggravation of tensions and therefore the potential of a wider war, you would reasonably expect to see money being allocated on safe haven assets, which safe haven assets are, for example, the United States dollar in regards to the FX market. You also have the Swiss franc and the Japanese yen. They have been deemed as safe haven assets, safe haven currencies, where investors allocate their money towards to if they have these kind of scenarios, recession, wars, and all that kind of stuff, famine, and all that. And you have also another safe haven asset that has been favored by investors in this kind of dire times, which is gold. Okay, gold is moving to higher ground, or gold is appreciating due to the higher demand in times of geopolitical unrest, war, famine, economic distress, recessions, and all that kind of stuff. Okay, so safe haven assets, remember, United States dollar, gold, you can have silver as well as one of them. You have Swiss franc, you have Japanese yen, and you have sometimes possibly some big kind of corporation, or at least let's speak about the largest corporation in the world, which is the United States economy. And therefore, you can see bond prices as well, treasuries rising in times of these kind of geopolitical risk. Okay, so safe haven assets are in demand or are hot when there are bad situations coming into fruition in the wider international scene. Okay, so moving on, we have bid and ask. Bid and ask are the same. They're going to be the stuff that you're going to be seeing in your trading platform when you want to buy or sell something. In a sense, bid is the buy price and ask is the sell price. And you have what we call the spread, which is the difference between the buy and sell. Remember, most of the times, basically all of the times, unless you have a slight rare exemptions, you're going to see the bid price, okay, the buy price is going to be lower than the ask price. The ask price always have to be above it. There's some exceptions, rare exemptions, but most of the times, as a rule of thumb, you're going to see ask price is going to be higher than the bid price, okay? So the price that you're willing to sell something is always going to be higher than the price that you're going to buy something. That's, in a sense, bid and ask, and you have the concept of spread, which is the difference between the two. Okay, so liquidity, easiest way to conceptualize liquidity is with a brief example. For example, with let's just say you want to buy an iPhone. Okay, so highly accessible technological invention, if you like, a telephone. Okay, so iPhone is certainly something, is an item that has high liquidity because there are many phones being produced in order to be offered or supplied to the market for those that want to buy it. Therefore, once you have an item that is of high demand, and you have also a matching high supply, you have what we call a high liquidated kind of item. And if you put it much more in market kind of oriented point of view, when you have an asset that is, when you describe an asset that has high liquidity, that means a lot of people are actively engaged in buying and selling it. Therefore, you have higher chances of transacting that and at much better prices compared to, for example, if you have a Nokia, remember those lovely phones, okay? Those indestructible
tools for war. Okay, those Nokia phones that are pretty scarce. You cannot find them much more in the market right now. You can brand them as a less liquid kind of item because there are not many buyers and sellers in the market that want to transact or offer this kind of phone in comparison, obviously, with the iPhone, which is a much more well accepted, okay, for the time being, phone that people want to buy and sell. Okay, so high liquidity means you have narrower kind of price action, much more competitive price action, whereas in assets where you have low liquidity, you tend to have larger spread, okay, because there are not many people in the market transacting for that specific instrument. Okay, so for example, if you want to have a comparison, Apple stock is definitely going to be much more liquid compared to a company that nobody knows and it's listed on Nasdaq and it trades for $1.50. Okay, some unknown company. Okay, so this is a brief comparison that you need to have in your head. Okay, so high liquidity means closer and much more nicer and much more competitive price action, whereas you have low liquidity, you tend to have larger spread and much more not that competitive kind of prices. Okay, so slippage in a sense refers to a discrepancy of price. Okay, let me explain what I mean by this. For example, you want to buy Apple stock, okay, and it's currently assumed that it's traded at $200. Okay, so whenever you are in the market and you want to buy something, okay, in your trading platform, and you press on the buy and you say, I want to buy this at market price right now, which is at $200. Most of the times you will get slippage, and slippage is in a sense the difference between the price you have pressed the button to get and what the actual price you got at the execution. Meaning, for example, I want to buy it right now and I press the button at 200. By the time I press the button to 200 and you have a market order, remember this, a market order, you may not get 200, you may get the $200.02. Okay, so in a sense, you're gonna have positive slippage. That means you have bought that specific stock, Apple in this kind of case, at $200.02 rather than the 200 that you press the button at that point in time. Okay, slippage is something that you will find in many occasions in futures markets. For example, if you're trading indices, if you're trading stocks, if you're trading commodities, if you're trading FX, whatever that might be, you're going to get slippage. Yet sometimes you're going to get a better price, you're going to have negative slippage. Sometimes you're going to get positive, and could be most of the times you could get zero slippage. That means you press the button at 200 and you get the 200 execution. Okay, no slippage. So remember briefly, you can have positive slippage, negative slippage, and zero slippage. Okay, something super technical, but still it's something that you come across when you start to trade. Okay, lastly, let's talk about risk on and risk off. When you hear someone say, the equity traders have put on their risk on hats, okay, that means in a sense they are willing to undertake much more risk, therefore they are much more speculative, they're much more aggressive in buying or selling something. Okay, that means that tends to lead in some sort of rallies or some sort of falls in price action, steep price action, falls and rallies. Okay, whereas in comparison, when you hear someone say risk off approach or risk off mode has been triggered or has been adopted, means they are much more careful and cautious in entering the market, and they undertake much more, not sophisticated, but much more prudent and much more cautious stance at trading. Okay, so risk on means aggressive, volatile price action and getting into the markets. Risk off means much more cautious, okay, and much more conscientious approach at trading. Okay, so in a sense, gives you a gauge when you hear someone say risk on, that means something is super bullish. Okay, on something that needs to push the price action higher to higher ground with a higher velocity or high momentum. Whereas when you say risk off, they are more reluctant, kind of bearish sentiment surrounding a specific instrument. Okay, so enough about key terminologies. Give me a second to have a sip of lovely water. So, moving on to the next. We went past our time. Let's wrap this up a little bit quick. Okay, so how much time? I'm going to ask a question here. It's an open-ended question. This is a subjective question, and the answer is going to be obviously subjective because you need to ask yourselves this kind of question and come up to the conclusion. I cannot tell you what kind of trader you will become or how much time you will be allocating on your own trading. I'm not in any sort of control of what you do, obviously. So the question here is an open-ended question, treated like a what-if kind of question. I'm here to introduce you a few modes of or ways of approaching trading in regards to what kind of strategies, what kind of type of trader you could become, depending on these parameters I'm just going to introduce right now. So how much time do you need to trade? It's certainly up to you as an individual, okay? So it varies from trader to trader, obviously, and we will discuss, excuse me, why does it vary, okay? You can say, what is this kind of question? It's pretty self-explanatory. Nevertheless, I'm going to go over it, okay? So it depends on the time you are willing to spend trading each and every day and what kind of trading style will you adopt in order to fit your work schedule, assuming that you work. If you don't, fair enough. If you want, for example, to dedicate all your waking up time at trading the markets, you could become, you could take or undertake the scalping kind of route, which in a sense, scalpers are entering the market and exiting the market at super short time frames. For example, they can be holding the position open for 30, 40 seconds, 1 minute, nevertheless more than 3 minutes. Okay, so this is what we call scalping trading or scalping activity, when you have traders entering and exiting the market mainly around financial news releases that have some sort of high volatility in order to capitalize upon that. So scalper most of the time tends to have a heavy workload, if you would like. They spend a lot of time on a daily basis looking at charts, looking at price action and trading. Okay, so you need a lot of time to actually apply and implement this kind of technique and this type of trading. Okay, so it requires a lot of man hours to do this kind of thing, or woman hours. Let's be inclusive in this kind of age. Okay, so another type of trader is a day trader who enters and exits positions within the day. So that trade might be opened, for example, at 10 o'clock in the morning and could be closed at 11, 12, or for example, afternoon. Okay, that's how a day trader might do his trading. Okay, might hold the position open for much longer, obviously, compared to a scalper. And it requires more or less 2 to 3 times a day prior let's just say, coming up with a plan and assessing the markets, getting the pulse of the market, or how is what is the direction of the market, what we expect today. They take a lot more information under consideration and act accordingly. Whereas in contrast to the first two, you have the swing trader, what we call a swing trader, who undertakes his assessment or trading plans. They take time, half an hour, 1 hour per day, in order to see if his position, his or her position, is actually on track. Swing traders normally have a position open for mainly 1, 2, 3 weeks, something like this. They essentially capture the waves of the price action. It obviously takes much less time compared to the scalper that needs to be glued to his screen from within the trading session of each and every day, or the trader or the day trader that needs to be paying also close attention to what's going on within the day. Swing traders, they are performing on a much longer kind of time scale. So in a sense, they may be entering, maybe opening up their charts and doing their analysis or keeping up with the markets, for example, for an hour a day, in order to see what has changed, because they're trading the macro, quote unquote, macro kind of trends, the intermediate kind of trends, rather than the day trends that scalper and the day trader are actually performing upon. And lastly, we have the position trader, which we call bag holders. In a sense, they go long, mainly they go long on a position on, I don't know, Microsoft or stock or crude oil or FX pairs, whatever that is. They take longer kind of position, hence the position trader term. They keep the position open for months, so therefore they don't need that much time to go in every day and study what's going on. Okay, they might briefly tune in, okay, open up their PCs or set their trading setups to see if the underlying trend is favoring their position or not, and they adjust accordingly. So you understand here, the time horizon is what defines what kind of trader you can become. Okay, so don't expect to perform well if you are you're willing to undertake the super short kind of trading approach, for example, scalping. Okay, buying and selling within the minute kind of period without doing your homework or without paying attention, but for an extended period of time is if you're willing to do scalping and you're not willing to put in the effort of studying and keeping an eye on what's going on for a prolonged period of time within your day, sorry to say, but you are just a gambler. So there's no possible way of trading efficiently and profitably as a scalper without paying attention to what's going on into the shorter time frame or the day-to-day stuff. So if that's not you, okay, if you don't want to blow out your account by just randomly placing trades without practicing or at least coming up with what's going on or assessing how the market works, don't do this, please. Just take a different approach. For example, use day trader kind of principles or swing trader principles and do a mix and match. So ultimately, it depends on how much time you're willing to dedicate into trading. If you're not willing to dedicate 4 hours of your own day looking at charts, don't become a scalper. You're going to lose your money quite fast. I've seen this a million times. Please don't do this. However, if you want to take a much more moderate approach, you say, I'm working a 9 to 5 and I have 2 hours on my afternoon to start learning to trade, take the day trader approach, take the swing trader approach. It gives you much more time to digest how the whole thing works, okay? Identify your positions, okay? And execute accordingly. Okay, so it ultimately depends upon how much time you're willing to have for trading. Okay, how much time you're willing to dedicate yourself and learning this kind of stuff. Okay, so what kind of trader you will become is ultimately upon you. Okay, so identifying your trading style, whether you like to trade gold or whether you like to trade commodities or whether you like to trade FX, find your niche. Understand what drives you to learn more about how the whole thing works. Okay, if you start by this, okay, with this approach rather than, oh, you know what, if I'm gonna trade stocks, I'm gonna become much more profitable than when I'm trading FX. That's not the case. Please don't approach trading like this. Okay, in my honest opinion, in my humble opinion, find the niche that you are good at. Okay, to the ones that you are interested in trading first, okay, and then start trading at it. Okay, so for example, you have a liking to how economies are behaving in regards to the wider economic market and sectors, and how does the employment data reports are impacting the FX market and currency pairs. Go on to FX. Okay, if you're willing to scroll through various different financial reports from companies, and you are willing to understand how, for example, a manufacturing company is performing, or how, for example, an auto manufacturer is doing, how the process of creating cars is coming into fruition, and, oh, you know what, I like this kind of process and I like this kind of companies. Fair enough. Learn how they work, how they operate, learn to read financial statements, and excel on the niche of equities. Okay, so find your niche by trial and error, obviously. Or, for example, you would like the development of commodity prices in the international markets. You like to see what kind of effect does geopolitical factors have on the price of oil, what kind of price action, what kind of price influence does, for example, a war has on crude. Learn those kind of dynamics and trade crude, rather than opening blindly positions on FX or on precious metals or on equities. So in a sense, find your niche. It's helpful to identify what interests you the most first, and stick to your strength at the beginning. And from there on, once you master this kind of bracket of assets, for example, commodities, move on to different ones. Okay, find your niche first, and then add on different stuff to your trading strategy. Okay, so again, this is another question that you need to address by yourself. You have to understand what moves you to learn more about something before trading that. Okay, hopefully that is helpful. Okay, so last slide, if I'm not mistaken. Oh, no, we have another two. Okay, so what kind of approaches can you undertake when it comes to trading? You can have the fundamental or the technical analysis, and or both. Okay, so what is fundamental analysis? Fundamental analysis looks at, in a sense, the macroeconomic factors that affect countries and therefore their respective currencies, and utilizes the economic calendar and financial news releases. This is fundamental analysis in regards to FX market. You can do fundamental analysis on stocks as well, and commodities as well. In a sense, fundamental analysis looks at news releases and financial releases and economic releases of different aspects of the economy, and therefore from there you gauge or you assess how that will impact the trajectory of any given asset you are currently studying. Okay, in contrast to the technical analysis in a sense looks at chart patterns and indicators that give out signals for trading. So therefore you're not primarily interested in what's going on with the wider economy, even though you should, because you can get severely valuable insights from doing the fundamental analysis. Okay, so technical analysis looks at chart patterns and indicators that gives signals for trading. Okay, and they use, in a sense, for example, various different indicators such as moving averages, momentum, RSI, Fibonacci, can have Elliott wave theory, Ichimoku clouds, parabolic saw, commodity channel index. All these I just mentioned, these technical indicators, these are going to be the stuff, okay, these topics that we will be discussing throughout this series. Okay, so we will venture definitely deeper into technical analysis. We're going to introduce each and every one of these technical indicators and how to assess them, okay, and apply them and implement these kind of traders onto your trading journey, and see whether they give you valid signals to buy and sell something, okay, whatever that instrument is. And we're going to do that also with fundamental analysis. We're going to go a lot more deeper into fundamental economic news factors, understand what kind of implications do, for example, the NFP print that we're going to have in a few hours' time from the United States, the employment report. What effect is the GDP rate of a specific country. You will have on currencies, how to read financial news, how to read financial statements from companies in order to make much more educated and sophisticated guess on what's going to happen with a specific company, whether that will be Apple, whether that will be Amazon, Microsoft, AMD, or Louis Vuitton, or whatever that might be. Okay, so we're gonna use and we're gonna dive deeper and we're gonna analyze the effects and the underlying basic components of both the fundamental and technical analysis throughout this series. So feel free to join and we will provide you with the basic knowledge, but also going to move on to a little bit more deeper and give you the top of the heap, if you would like, of the cream of what makes or why do people pay attention to these kind of techniques, okay, either fundamental or technical, and how they can benefit and elevate your own trading. Okay, so we will be discussing these kind of topics throughout this series. Feel free to tune in. Okay, so what products can you trade with T4Trade? Since we have this webinar and we have 2 minutes, I'm going to do a brief overview of what we can trade on T4Trade, since you chose T4Trade as your trusted broker. So you can trade FX pairs, you can do you can do FX pairs, you can do metals, you can do commodities, equities, and indices. So these are the main categories. So you can trade, for example, Euro USD, GBP USD. You can trade the dollar against the Japanese yen. You can also do gold, silver. When it comes to metals, commodities, you have oil, you have natural gas, you have coffee, you have cotton, you have orange juice, you have cocoa, you have a lot of stuff. Same thing with equities. You have the opportunity to trade Apple, Meta, Amazon, as I just mentioned, Nvidia, and all that kind of stuff. And lastly, we have indices, S&P 500, US 100, and NASDAQ. Let's move on to the website to see all this kind of lovely stuff easily categorized here. Okay, so we go into the markets and you can clearly see which kind of instruments you can trade. For example, you have Forex, you have metals, indices, commodities, futures, and shares. Let's go for an example for shares. Okay, what kind of shares, what kind of stocks you can trade, CFDs. And you have, if you scroll enough down, you have trading conditions and specifications, and you have all the list of the stocks you can trade here, okay, as well as the minimum spread and the margin that is required for you to trade. Okay, so also you have this lovely function here, T4Trade LiveTV. I present on a daily basis the economic and news releases coming out, daily commentary of what to expect throughout the day, what happened during yesterday's session, and what to expect. We also give a lovely projections of what is going to happen into the coming period. So feel free to join whenever you see fit and get your lovely updates. Okay, for the time being, this has been the end of today's session, guys. Thanks for watching, and we'll catch you on to next week for another session, okay, where we're going to be discussing technical analysis principles. We're going to do a brief intro into technical analysis. Okay, for the time being, thanks for watching. Take care. Bye-bye.